Hello, everybody. This is Andre Kwan and Stuart Gill with Evolutions App. And today we're talking about if you've been affected by the coronavirus or if you've had any issues in terms of loss of wages or loss of employment. So with that being said, we're going to get straight into it today because we know time is valuable for everybody. Stuart, as we've been moving through this time and uncertainty, what have you learned through the process in terms of how to help yourself or help others that might have faced this problem?
Well, this is a tough episode for me to talk about because it kind of goes against my core values and beliefs. You know how I feel about debt. Debt to me is a mortal enemy. It's like this big burden on your shoulder. Whenever you have debt, the money that you have, the income is not truly yours. It comes in, the income comes in, it goes right out the door to pay that mortgage, pay that car payment, that rent or whatever. So I'm a big advocate of paying down debt, be 100% debt free as fast as possible. But when you're faced with a new time like this, the COVID-19 pandemic, you have to adjust. When you take it back to 2008, the Great Recession, the housing pandemic, the housing crisis, credit card companies actually were automatically lowering people's limits. So if you had a $10,000 credit limit, it would take down to $5,000. Or even at some points in time, they would pay people to close their accounts. And heaven forbid, if you're relying on your credit, score and your amount of credit you have in a bank to pay off your bills, and all of a sudden your credit, limit drops down all of a sudden. So that being said, I, for the first time, am recommending don't pay off all your debt in full. Don't pay those credit card balances down to zero. Save that cash as much as possible. We talked on the last episode about having an emergency savings fund. And if you're a dual family income at this point in time and one of you lost your wages, you're all of a sudden split to 50%. How are you going to make do? Or even worse, if you're a single family income and you lost wages, 100% of your wages or a reduction of wages, you're really struggling right now. So that's when that savings comes into play. And because of this recession we're going into, or this pandemic we're facing right now, we don't know when the economy will return. We don't know when we'll go back to work or, small businesses will reopen. So that being said, you need to save that cash. So for the first time, I'm suggesting put some stuff on that credit card. Pay as many of your recurring bills on your credit card and pay the minimum balances, but just keep that cash flow going. Because at some point in time, you're going to need that cash to pay your mortgage or pay for groceries. So this is a different time for us.
I agree with you, Stuart. We touched on it a little bit last episode. So as a reminder, we're all sitting at home trying to figure things out. Go through your bank statements. One exercise that we've always done is look at your last 90 days. Are there areas that we can cut in terms of going through your checking and savings? Just print it out, go with the highlighter, figure out those little subscription services that you never use anymore. Not to throw anybody under the bus, but for me, I was paying $14.99 to Adobe Acrobat for the last 36 months. I had no idea. So things like that, you could definitely cut from there and be able to save. Other than that, like what have you seen from either conversations with, business owners or friends that had a challenge of employment or lost wages?
Well, we can speak directly to it, right? So we've had during this period of time, furlough some individuals on our team. Certainly we stopped paying contractors. They were the first to go. And as you know, as a small business owner, we pay ourselves last, right? So our commitment to the employees that we pay them, bi-weekly or twice a month on the 15th and the 30th. And when you can't do that anymore in good conscience, you have to do what's right for the business and for the employees. And, what you and I struggled with was, when do we do it? Do we string it on as long as possible, keep our employees employed as possible, keep the system going to help them? But also, are we preventing them and slowing down the process for them to apply for unemployment themselves? So it's a constant balance. For myself, as in 2008, when this happened, I was with another company that I owned. I was an owner of, and we had to lay off people. And that was one of the hardest conversations I've ever had. I've terminated individuals in the past. It was always because of something that they were doing or not doing. They were underperforming. So it's kind of a conversation like, hey, you obviously don't want to be here or you're not making the cut. But a termination for performance is drastically different than being laid off. Saying, hey, employee, you are an amazing employee, would love to keep you, but I just can't. That's the difference between being laid off and furloughed. Laid off implies the position is no longer available because of an economic downturn, downsizing, or a system readjustment. A furlough sounds a little better in the sense that it's like a shortened period of time where you are temporarily unemployed, but you still exist on the payroll. You're still, in terms of employee member of the staff, but you're just not receiving any hours. And the kind of the commitment behind it is once business comes back to normal, you'll be coming back to your normal wages. But for a transactional sake, furlough and being laid off are both the same in terms of the government eyes, so you're still eligible for unemployment insurance.
And maybe just to expand on that point a little bit from the lending side of the world, when there are two different opportunities that you just kind of, or I'm sorry, that we'll talk about right now. In terms of the furlough, you can still get a mortgage if you are furloughed, as long as there's a plan for rehiring. So that's one thing to know. So, you could save thousands of dollars potentially by trying that opportunity. And then the second thing that's come out is the difference between a forbearance and a deferment in terms of a mortgage loan. And that's not just for your primary residence. It's to surprise of many. Obviously, it's a great opportunity and a great tool to use if you do need it. But if you don't need it and you are able to make your bills, consider an opportunity to try to contact that servicer. And instead of asking for a forbearance or a deferment to be written on your mortgage and how it reports to creditors, you want to ask for that your mortgage is affected by natural disasters. And why you need to do that is because if you ask for forbearance and they mark that on your credit report, you're typically going to get denied for a mortgage because you need to have a clean credit history on your mortgage account for the last 12 months. And doing that simple phone call, if your servicer is able to mark that it's affected by natural disasters, that's actually still okay. It's a small little change. Not a lot of people know that, and new things are coming out daily, but those are prime points of information, especially if you're going to, if you have an average rate of 5% on a mortgage, on a $400,000 mortgage, and you're trying to get into the threes, that could be a huge factor, especially if you accidentally choose, like one consumer had told us it was as simple as clicking a box that he wanted to have a deferment, a forbearance, and that eliminated his opportunity to get that mortgage. So that was, unfortunate, but those are the things that we need to learn at these times.
If I am recently furloughed and looking to buy a home, and you said if I'm furloughed, as long as there's a plan for me to return back to work, what does that plan look like? Is that just a conversation with my employer that they write a letter, or is there an official process, or do I just tell my mortgage company, or that I was furloughed and I'm in good standing? How does that work?
Yeah, great question. There's a couple of different things. So behind the scenes, typically lenders across the nation are able to order what's called a verification of employment. That verification of employment is a lot of the times electronic. So they'll be sent out to the HR division to be able to fill out automatically. In terms of the furlough itself, they want to see a couple different things. Number one, that there's a approximate return date set. And then secondarily, in order to consummate the loan, to fully fund it, they want to see that you actually have a new pay stub back in place. So it's not as simple as, hey, I'm going to talk to my buddy who's an HR manager, and I'll just have them write a letter. They want to see two proofs, right? The first, that there's an expected date of return, and secondarily, a pay stub that will validate those claims that were made.
Makes sense. I have another question. So if we're following my, heavy advice about, not paying off your credit cards in full and debt, I also suggest people go out, contact your landlord, contact your utilities company, contact wherever your car loan's going through, and ask for a deferred payment if possible. But it's also super important to inquire if that's going to hit your FICO, meaning if they are going to report that, deferment agreement to the credit bureaus. Is that something we should be aware of? Is it something we can ask them not to do? If I go to my, utilities company and say, hey, I want a deferred payment for an extended period of time, it might save me cash now, but will that affect my credit score later on down the line and, halter future action movements?
Yeah, great question. I think it's going to be case by case with each servicer, but as a rule of thumb between all of us that are watching, listening, learning, contact every servicer and ask them if it's going to affect your credit by making any kind of change to your account. You want to move forward if possible without having your credit impacted at all, and try to get that in writing if you can, because you never know, right? Like if you put a loan of any sort, credit card, student loan, car payment, on deferment for 90 days, you have to weigh the benefit. Is it the fact that you didn't pay 3 months worth of, let's just call it a $50 minimum on a credit card, worth it to impact your credit score by having 3 months worth of your account showing that it was in forbearance and deferment? which would typically have a negative impact on your score.
Right. You know, no matter what guys here, I think this is a great time as you start off, you know, talking about your $39 payment for Adobe. You know, you should always be, we should always be auditing our accounts, our budget on a monthly basis. Maybe not every day, you don't have to be a penny pitcher that way, but on a monthly basis, there's things that can creep up. A subscription you didn't even know you had or don't use anymore, that's kind of obsolete, or there might be a better deal or better package out there. I know, you know, yearly I seem to call my mobile service provider and ask what new deals are out there, what can I get in, or is there a legacy package because I've been with you so long. So we might have gotten to this point because of the COVID virus, but it's a great opportunity to, like, you know, not only just take a step back for ourselves, but also take a step back and look at our financial plans, our goals, and where we are, and reduce those expenses, increase that, you know, reduce that outgo. So maybe when we have a time where we're move forward after this possible. That's a lot of mumbling, a lot of stuttering. My bad.
No, it makes sense. Let's take a break here, and then
that's that debt. That's that debt just weighing me down. Just got me shook.
Shoulder load of weight there. So let's take a break here, and then we'll be right back here.